Welcome to the Opening Bell Report.
We're looking at the Q4 2025 earnings analysis for Astralab's ticker ALAB. And the reaction is just, it's confusing.
Confusing is one word for it.
Yeah.
Contradictory might be a better one.
Right. I mean, here's a company that just dropped what, by any definition, is a beat and raise report.
Absolutely.
They beat on earnings, they crushed revenue, they even raised guidance. And yet, I look at the after hours, and the stock is down 10%. It's sitting around $164.50. So I guess the mission for this deep dive is pretty clear. Is the market broken? Or did the algos find some huge red flag that the rest of us just missed?
It's probably neither of those, actually. What we're seeing here is a classic disconnect.
You have to think between what?
Between the headline panic metrics and the actual structural health of the business. The market and, the algorithms, they're hyper-focused on one single number, gross margin. They saw a tiny dip, and they sold. But if you actually read the full analysis, especially of the cash flow statement, that sell-off looks like a mistake.
So everyone's staring at margins, but you're saying they should be looking at the company's bank account.
Specifically, operating cash flow. There is a hidden gem in these numbers that suggests Astera isn't just growing, it's transitioning.
Transitioning to what?
From that high-growth startup phase into what I'd call a cash compounding machine. And that shift is, frankly, worth a lot more than a 10% drop suggests.
That's a pretty bold claim, especially with the street selling off like this. But, okay, before we get to that hidden gem, let's start with the crime scene. What actually happened in Q4? Let's just lay out the baseline numbers.
The headline numbers were, objectively very strong. Revenue came in at $270.6 million.
Which is up 92% year over year.
92%.
Let's just pause on that. They basically doubled the size of their business in a year. That's not normal.
It's exceptional. And crucially, they beat the consensus estimate of $260 million. So even with high expectations, demand is accelerating faster than Wall Street thought.
And what about the bottom line?
They delivered earnings per share, the non-GAAP number of 78 cents, which beat the forecast of $1.51. And GAAP net income was $45 million. That's up 82%.
So they're selling more stuff and they're keeping more of that money as profit. Usually that's the recipe for a stock to go up. So why did the bears come out? You mentioned gross margin.
That's the culprit. So gross margin came in at 75.7%.
Which in a vacuum for a hardware company is fantastic.
Well, it's elite territory, but in the previous quarter, Q3, it was 76.4%.
So we're talking about a drop of, what, 70 basis points? Less than 1%?
Exactly. And this is where you have to get inside the mind of a hardware investor.
Okay.
People in the semiconductor space, they are terrified of one thing, commoditization. They wake up sweating about it.
Right. The fear that their special chip becomes just another cheap commodity.
Exactly. So when they see margins tick down, even by 0.7%, the immediate fear is, oh no, they're losing pricing power, competition's heating up, and Astera has to discount their products.
And is that what's happening? Is there a price war brewing?
No. And that's the whole nuance the panic sellers miss. This isn't a pricing problem, it's a mix problem.
The mix problem, what does that mean?
It means it's about what they're selling. Astera isn't just selling tiny silicon chips anymore. They're selling more and more full hardware modules.
They're PCIe and CXL modules.
Right. Those complete packages.
Okay, break that down for me. Why would selling a bigger, more complete module hurt your margin percentage? I think it's a more expensive product.
It is more expensive, but think of it like this. When you sell just a tiny chip, the material cost is super low, so the margin percentage looks huge.
Right.
When you sell a full module, that's the chip plus the board, the connectors, all of it, your revenue goes way up because you're charging more. But your cost of goods sold also goes up. You're paying for all that extra metal and plastic.
I see. So the percentage might dip a little, but the actual number of profit dollars you're making goes up.
Precisely. They are trading a tiny sliver of percentage points to capture a much larger piece of the customer's wallet. It's a strategic move to get embedded deeper in the data center.
But the trading algorithms just saw margin down and hit the sell button.
They saw 76.4, drop to 75.7, and triggered the alarm. They completely missed the forest for the trees.
That feels incredibly short-sighted.
Oh.
Okay, so the margin dip is explained, but you said the real story, the truth of the report, is in the cash flow. Walk me through that aha moment.
Okay, this is where the entire narrative flips. If you ignore everything else and just look at Astera's operating cash flow OCF for the quarter, they generated $95.3 million.
$95 million.
In one quarter.
Yep. And that represents a 202% increase from the same quarter last year.
Hold on, wait a minute. Their revenue grew 92%, but their cash flow grew 202%.
Yes.
So cash is growing more than twice as fast as sales. That's a huge divergence. That is the whole story. You have to look at OCF as a percentage of sales. It tells you how good a company is at turning a dollar of revenue into actual cash in the bank.
Okay.
A year ago, back in 2024, Astera was around 10, maybe 15%, sometimes barely breaking even on cash. Totally normal for a company in hypergrowth.
Right, the old burn cash to grow fast playbook. Spend everything on R&D and sales, worry about profits later.
Exactly. But Astera just broke that playbook. In this quarter, Q4 2025, their OCF margin hit 35.2%.
So for every dollar of sales, 35 cents is hitting their bank account as free cash.
Yes, and you have to understand how rare that is for a company also growing sales at 92%. Usually you get one or the other. You're either a slow-growth cash cow or a high-growth cash burner.
Man, Astera is somehow doing both.
They're saying, why not both? They are scaling at an incredible speed while printing cash.
Now, are they just gutting R&D or something? Because for a tech company, that would be a really bad sign.
Nope. R&D spending is actually up in absolute dollars. They aren't cutting corners. This is the magic of operating leverage. Their revenue grew 17% just from last quarter, but their fixed costs, rent, base salaries, they didn't grow nearly that fast. They're a fabless chip company, so they don't have to build giant factories to scale.
Yeah, so the business model itself is just incredibly efficient. It doesn't cost them much more to make a lot more money.
Correct. And that brings us to the real question of valuation. If you're listening and you see the stock drop to $165, you have to ask, is 35% cash margin actually good compared to the rest of the industry?
Right. Context is everything.
Yeah.
How does that stack up against the big dogs?
Well, to answer that, we have to look at the gold standard in this space. We have to look at Broadcom, ticker AVGO.
Broadcom, the final boss of semiconductors.
They really are. Broadcom is basically a cash printing machine. Their gross margins are around 75%, which, funnily enough, is right where Astera is now.
Okay.
But Broadcom's cash flow margin is a staggering 48%.
48%? Wow. Almost half of every dollar they make is pure cash.
It is the goal everyone in the industry is chasing. Now look at Astera. A year ago, they were at 10%. Now they are at 35.2%. They are closing that gap to Broadcom at a frightening speed.
So the thesis is that we're watching Astera evolve from a hardware startup into a junior Broadcom.
That is the trajectory. And to show why that matters, compare them to other peers. Take Marvell, MRVL. Great company.
Huge player.
Huge. Their gross margin is a bit lower, around 60%, and their cash efficiency is typically around 28%. Astera has already blown past them on efficiency.
And Marvell's been at this for decades. That's a big deal.
Or look at a younger competitor like Credo, CRDO. They're growing fast, about 45%, but their cash efficiency is only around 18%.
So Credo is burning more cash to get half the growth rate of Astera.
Exactly. When you frame it that way, that 10% stock drop looks silly. The market is pricing them like a simple widget maker, but the cash flow says they're becoming a platform monopoly.
Platform monopoly. That's the key term. A 35% cash margin suggests they have a moat. It suggests customers are sticky.
They're not just buying a generic part. They're buying into the Astera ecosystem. The software, the controllers. Once you design that into $1 billion AI data center, you don't just rip it out to save a few pennies.
Because the risk of failure is way too high. You're not going to risk downtime to save $10 on a connector.
The cost of failure is basically infinite compared to the cost of the component. Astera knows that.
So if the fundamentals are this strong, why the volatility? Is this just how this stock trades?
It seems to be. And we actually have history as a guide here. If you look back just one quarter to Q3 2025, we saw the exact same movie.
You're kidding.
No, they beat revenue by 10%. The stock immediately fell 5% on the news.
And then what happened?
Over the next 8 weeks, it rallied 30%.
So it's a pattern.
Yeah.
The fast money sells the headline, and the slow money buys the fundamentals.
It certainly looks that way. The initial reaction is emotional, it's fear. The secondary reaction after people actually read the filings is rational.
Speaking of that, is there any sign the bigger players, the institutions, are actually buying this dip?
There's a technical clue in the trading data. It's a metric called on-balance volume, or OBV.
Right. Break that down for anyone who's not a technical trader. What's it track?
Simply put, it tracks if more shares are being bought on up days versus sold on down days. It's a way to see if smart money is quietly accumulating a stock.
Okay. And what's it doing with ALAB?
Here's what's fascinating. Even though the price dropped 10% to $164, the OBV did not drop proportionately.
Meaning someone with big pockets was stepping in and buying all the shares that the panic sellers were dumping.
Exactly. While momentum traders were selling, significant volume was absorbing that pressure. That's a classic sign of institutional accumulation. They use these drops as a chance to get a big position.
That lines up with their balance sheet too, right? I mean, how healthy are they financially?
They have a fortress. We're talking about $1.19 billion in cash on the books.
Over $1 billion in cash.
With negligible debt. Their debt-to-equity ratio is something like 0.05. It's practically zero. They can weather any storm.
Okay, but let's play devil's advocate. Maybe the market is worried about the next quarter. Q1 2026. Did their guidance suggest things are slowing down?
That's the thing. The guidance suggests the party is accelerating. They projected Q1 revenue to be between $286 million and $297 million.
So they just did $270 million. So they're guiding for sequential growth. Again, in what's usually a seasonally weak quarter for chips.
Exactly. Growth is not slowing down. And because of that strong guidance, the analysts covering the stock have actually been raising their price targets all morning.
Where are those targets sitting now?
Most of the new ones are in the $200 to $225 range.
So the stock is at 164 range, and the analysts who actually crunched the numbers are saying it's worth closer to $225. That's a huge disconnect.
It is. It's the gap between sentiment, the fear, and the reality, which is the acceleration of cash generation.
So to bring it all home, we've got a company that grew 92%, beat all the estimates, has $1 billion in the bank, no debt, and is seeing an explosion in the quality of its earnings, hitting 35% cash flow margins.
And yet, because the gross margin percentage dipped by less than 1% due to a strategic move to sell more valuable products, the stock went on sale.
It really is a lesson in looking past the headline. If you just saw the notification, ALAB down 10%, you assume the story is broken. But the business is actually healthier than it was when the stock was higher.
That's the paradox of earnings season. The noise is loud, but the signal is in the cash flow statement.
Which leaves us with a pretty provocative question to end on, I think.
Yeah.
If Astera Labs is already generating these 35% cash flow margins while they're still in this insane hyper-growth mode, what happens when they actually mature?
That is the multi-billion-dollar question, isn't it?
What happens when their tech is so entrenched they don't have to fight so hard for growth? Are we looking at the next Broadcom-style monopoly before the rest of the market even realizes what's happening?
The data is certainly pointing in that direction, but as always, the market will take its own sweet time to figure it out.
And until then, we'll keep watching the cash flow. That's a wrap for this deep dive. Thanks for listening, and we'll catch you on the next one.
Don't forget to like, share, and subscribe for more.